the Teaching Tax Flow podcast, where the goal is to empower and educate you to legally and ethically minimize taxes paid over your lifetime.
Welcome back to the podcast, everybody. Today on episode 60, we're going to jump headfirst into the top 5 year-end tax strategies from none other than Chris Picciero, here, founder and educator of Teaching Tax Flow. But before we do that, as always, let's take a brief moment and thank our sponsor.
This podcast is sponsored by Reps Tracker. Are you a real estate investor who is bogged down with a huge tax burden? Real estate investing can open the door to powerful tax benefits. Reps Tracker can streamline the process of accelerating these tax benefits. To take advantage of a special TTF community discount, go to www.repstracker.com/affiliate/teachingtaxflow and use the code IFG. You can look in our show notes or email us at hello@teachingtaxflow.com.
Hey, everybody, and welcome back to the Teaching Tax Flow podcast. Today, we're going to take a quick look. We won't get into too many details, but our top 5 year-end tax strategies for 2023. But before we do that, one thing that I'm going to challenge you to, well, actually, if you didn't do it this year, you better do it next year. If you happen to be listening to this on Spotify, they actually just announced, it's in your Spotify app, kind of your year wrap-up, and it shows your favorite artists, how much music you listen to, etc. But this year, it actually added into that, if you Spotifyers haven't noticed, what your favorite podcast is. So we expect to see the Teaching Tax Flow podcast on there. Heck, if it's on there, send us a picture of it. Maybe we'll mail you a cool little prize. But no cheating, but that's a challenge. So, trimming the fat a little bit, let's get down to the chase. Chris Picciero, welcome back, man. You ready to talk your top 5?
I am really excited about this podcast, John. Welcome back to yourself. Happy holidays, where we've got about 1 month left in the year here in 2023. One of the laws of Teaching Tax Flow is that your tax return is a verb, not a noun. So tax planning should be occurring all year round. But what we want to
tax planning is never really done. You never check the box and say, yes, I'm 100% planned forever, right?
Exactly. That being said, one of the things that's important to us is timing. And I want to walk through my top 5 year-end tax planning strategies. Now, before we throw the Teaching Tax Flow community into a tizzy, because they may have heard me say something about another strategy that I like more. This is not my top 5 tax strategies. This is my top 5 tax strategies that you have to implement in December with a hard deadline of January or December 31st. So that is something that we thought was urgent. It's something that the tax flow community, Teaching Tax Flow community wanted. So let's talk about the top 5 year-end tax strategies. And then when I tell you about the strategy, I'm going to tell you in general who it would be best applied to.
Awesome. And Chris, I'm trying to toggle my memory here a little bit. I feel like it was just yesterday. It probably was almost a year ago exactly on multiple shows. You know, I always use the reference of, so this is what you either have to do or you can do it after, you know, the ball drops at 11:59 p.m. if you're out hanging with friends. And I think you gave me some tease, we should say, be like, man, every analogy you make, you're out drinking with friends. So we won't give that example. We'll just say after the new year or before it, I will shut my mouth. So let's hear these things. So the clock is ticking already on this. So that's why we chose to do this early December. These are the year ends. Let's get rolling, my man. Hit us with your top 5.
Correct. In no particular order, by the way.
Ooh, okay. Can I have that caveat in there?
Ooh, we're dripping with drama here. One of my top 5 would be for someone that is in a green diagnosis. Green diagnosis in our Teaching Tax Flow system means you are in a low marginal tax rate. And for someone that is in a low marginal tax rate this year, they should consider doing a Roth conversion. What that means is they're taking money from a pre-tax account, let's say a traditional IRA, they're converting that to a Roth. There's no limit on that conversion. The conversion amount is taxable at whatever your marginal tax rate is, which in this case it would be low. but there's no early distribution penalty if you're under 59 and a half years old. So we use the Roth conversion strategy on many clients that are at a lower marginal tax rate in the green diagnosis. And guess what? You could be very wealthy and have a lot of cash flow. Remember, John, tax flow doesn't equal cash flow. So for our real estate investor clients that maybe bought some new properties, then did a cost segregation study, so they have these big deductions coming from their real estate that might even exceed their income, this is a good way to take advantage of that. So Roth conversion is one of my top 5 strategies. You have to do it before the end of the year, and whatever the converted amount you utilize will be on what's called a Form 1099-R, but you've got to get that done before December 31st.
Awesome.
And that's different than a Roth contribution. So it's called Roth conversion. That's number 1.
Looking at number 2, so that was a good one. We hit a green diagnosis for that one. So I'll let you kind of keep rolling with that one, but I think that one will apply to a good amount of people. So I'm glad you started with that one.
Oh, hey, my pleasure.
And I know you're in your brain, you're probably thinking like, oh man, I got to nail this thing down to 5 of them. You're probably changing it in your mind right now on which ones are your favorite, but it's all good.
Right, exactly. Well, I'm thinking about which ones are so time sensitive that they have to be implemented, by the end of the year. So number 2 would be the bonus depreciation deduction. Now you might say, well, that deduction occurs on your tax return, which is true, which doesn't happen until next year. But an asset has to be placed into service before December 31st of 2023 to be eligible for bonus depreciation. Now, we're not going to talk about what assets in detail are eligible for bonus depreciation, but in general, automobiles over 6,000 pounds, equipment, furniture, could be a tractor for a farmer. It could be a variety of things. But you have to have that asset placed into service, not ordered, but placed into service by December 31st to be eligible for bonus depreciation. Bonus depreciation for 2023 is 80%. It was 100%, and it's only going to be 60% next year under Tax Cuts and Jobs Act. So my number 2 would be taking advantage of the bonus depreciation deduction, which would entail placing a needed asset into service. Now, I always talk to our private CPA firm clients and our teaching tax law community about don't let the tax tail wag the dog, meaning don't go buy a $100,000, 9,000-pound vehicle just to get a deduction. Get a new vehicle if your business needs it, if it's going to help you with efficiency. Or go buy a piece of equipment, or it could be computer equipment. It could be, if anyone actually still uses printers. It could be, especially for people that have a medical practice, it could be a very expensive medical device, new dental chairs. Now you can't just order them. They've got to be placed into service before the end of the year to be eligible for that bonus depreciation. So some type of equipment purchased and placed into service, as long as you're going to need it, especially if a private CPA firm client says, hey, I really need this new piece of medical equipment. It's $60,000. I'm going to need it by February 1st. I'd say just then get it now. Get it now, place it into service. And remember, cash flow doesn't equal tax flow. So it doesn't matter if you finance the entire purchase or if you pay cash. That has nothing to do with your depreciation deduction. So number 2, place a bonus depreciation eligible fixed asset in a service that is needed.
So if you're looking for a new private jet, this is the time to do it, as long as they can deliver in 30 days.
Well, as funny as it sounds, John, we have someone that's been on this podcast, and maybe we'll bring them back on, that works in fractional aircraft and jet purchases and leases, and there's some tax benefits for people in that. As funny as that sounds, but absolutely
great topic too. I love talking with them about that. We had a great conversation. I think I was drooling the whole time. I was just blown away with how it works, and the fact of owning a private jet. I don't have a big enough parking lot for it. No problem there.
Right. No, I hear you. Well, so number 3 is going to be income shifting to family members. So for eligible people that have a business, that have family members that work in the business, it might make sense, assuming that family member is doing legitimate work for the business. So if you are in a, just like the bonus depreciation, you've got to be in a red diagnosis. So red diagnosis in teaching tax flow means high marginal tax rate. And if you have someone in your household or in your family that's working for the business, doing legitimate work, you can pay them a reasonable wage for their work. And if that person, think about it, if it's a dependent, if that person's tax rate's 10% and your tax rate's 35%, there could be significant tax savings. It could be a spouse. Typically, you're not seeing a ton of tax savings when you pay a spouse unless it's paired with employee benefits. So when I say income shifting, that does include employee benefits as well, which could be employer-sponsored retirement plans. But the bottom line is that income shifting, if it makes sense for the business owner, that income shifting has to be done by the end of the year. You can't pay someone your cash basis taxpayer. I can't pay my child in January and pretend it happened in December. If I had a time machine, no offense, I wouldn't waste it on that. So, number 3, income shifting to family members is a really powerful tax strategy that is rather time sensitive.
That's a good one. A good one a lot of people don't know legally and ethically exists.
Exactly. So the first one, Roth conversion, is really good for anyone. The last 2 really pertain to business owners. I want to wrap up with my final 2. I want to wrap up with 2 strategies that I think pertain to almost everybody. Now, I'm going to bounce back to the green diagnosis. So let's say you are in that low marginal tax rate. One of the opportunities you have would be capital gain harvesting. What that means is that, let's say you have assets in your brokerage account, let's say stocks, mutual funds, et cetera, and you want to free up some cash. Or you're in a situation where that stock has gone up and you know you're going to sell it at some point in the near future, but you're in a low marginal tax rate this year, you might want to harvest those capital gains, meaning sell the security, sell the stock, mutual fund, or whatever, and recognize those gains in 2023 because you're going to pay very little to no tax. This is especially important if you have what are called capital loss carry forwards. So if let's say you had a $10,000 capital loss last year, John, and no capital gains, you can only deduct $3,000 a year of losses. The remaining $7,000 has to carry forward. So you would be eligible for good candidate for capital gain harvesting. Obviously, don't let the tax tail wag the dog. Make sure you work with your licensed financial advisor to determine what stocks to harvest capital gain. But I see for a lot of clients, imagine that a stock went up and this year your income's $12,000 for whatever reason. Next year it's at $200,000 and you happen to sell it in January 2nd and you're paying tax based on a $200,000 income, not a $12,000.
So if you're hanging on to that Amazon you bought at $190, you might want to consider a little change.
Exactly. So that's capital gain harvesting, green diagnosis. My final strategy, 5th and final, is a cousin of capital gain harvesting, capital loss harvesting. It's the exact opposite. It's for a red diagnosis, someone that is in a high marginal tax bracket. Let's say you have, again, work with a licensed financial advisor, but let's say you have stocks, bonds, mutual funds that have gone down in value and you don't think they're going to come up. Well, you might as well sell them. You still have the same amount of money. It's just cash, not stock. But now you have a capital loss deduction. Now, these capital loss deductions, you can deduct up to $3,000 a year if you're married filing jointly, $1,500 otherwise, if married separately or single. Married separately is $1,500. Everyone else is $3,000. But you could deduct $3,000 a year, but the remaining capital losses carry forward, so they're not lost. And this is especially valuable if you have other capital gains. Sometimes you have capital gains and you don't even realize it. Let's say John, you bought that stock and you have a financial advisor that's managing your portfolio and they're buying and selling things, and you have $50,000, $60,000 of capital gains, but you don't have any cash in your pocket. It's just getting traded in your account. And that's where at the end of the year, we work with a lot of people on, okay, what are your capital gains? Let's harvest some losses to mitigate that income. So the thing I like about the capital gain and capital loss harvesting, those last two, is that that doesn't require you to take any cash out of your pocket. All you're doing is selling securities. And that's why those are especially powerful. So I'll run it back down. Number one, in no particular order, Roth conversions, green diagnosis, low marginal tax rate. Number two, bonus depreciation eligible machinery and equipment placed in a service for typically a business or rental property owner. Number three, income shifting to family members, another red diagnosis for businesses or rental property owners. And then number 4 or 5, the cousins, the brothers from another mother, capital gain harvesting for the green diagnosis client, capital loss harvesting for the red diagnosis clients.
Excellent. And that's a good little mic drop for you as we wrap this up too. So Chris, thanks for running through those with us. We are going to get out of your headphones, your speakers, whatever you're listening to this on right now. Again, the clock is ticking. The calendar year end is not going to wait on you. So get moving on it. Chris, thank you for sharing those. Everybody who listens to this podcast, I will drop a couple notes a couple links in the show notes in reference to some of the resources we have within Teaching Tax Flow. I know we have a couple courses that are on a few of these strategies as well. They're free. Log on. Goes in a lot more detail on them specifically. And definitely don't miss next week's episode. I think you're really going to appreciate this one. It appeals to the masses. It's a different topic. It's definitely towards a lot more people, I think, than we usually jump into. But enjoy it. As I always close out now, it's same time, same place here next week on the Teaching Tax Flow podcast. Thank you, everyone, for hanging out with us here on this episode when me and Chris dove into those top 5 year-end tax strategies. And like most good things, they must come to an end, right? Just like the calendar year. So what that means is, as we alluded to many times in this show, don't waste any more time. Get prepared. Get planned. Let's do this together. Any questions, reach out to us regarding tax planning. We actually offer through Teaching Tax Flow a very, very fantastic, to say it even lightly, there is a tax planning, personalized tax planning product we offer to all of our members and anyone who may be interested. If you're looking for more information on that, be sure to visit our website, as well as shoot us any questions, shoot us any messages. We are happy to tell you about that product. We're creeping up on the end of the year. I was looking for a different way to say that one, but we're under 30 days. Let's put it that way. If that doesn't get the mind flowing. So with that being said, turn this off, get in the right mindset. Let's do this together, as I mentioned, and be sure to keep following us here on the Teaching Tax Flow podcast.
The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer.